Welcome back to the base school.
Have you ever looked at two companies' profit statements and thought, why are they presenting performance so differently? That confusion is exactly why IFRS 18 was introduced. IFRS 18 is a new accounting standard that focuses on how information is presented and disclosed in the financial statements. In simple terms, it is not mainly about changing what gets recognized, but about improving how financial performance is shown, especially in the statement of profit or loss. It was issued in April 2024 and becomes effective for annual reporting periods beginning on or after January 1st, 2027, although early application is allowed. So, what is the main goal of IFRS 18? It is trying to make company performance easier to understand and easier to compare. Investors often struggle because different businesses use different subtotals, different groupings, and different adjusted profit numbers. IFRS 18 brings more structure. The first big thing to know is that IFRS 18 introduces defined categories in the statement of profit or loss. These categories help users see where income and expenses are coming from. The major categories are operating, investing, and financing, plus income taxes and discontinued operations. This helps create more consistency across companies. The second major point is new required subtotals. One of the most important is operating profit. Before IFRS 18, operating profit was commonly used, but it was not consistently defined in IFRS. Now, the standard gives more discipline around that subtotal, which should make comparison easier. The third key area is something called management-defined performance measures, often called MPMs. These are the profit measures management chooses to communicate outside the IFRS required totals, like adjusted operating profit or normalized earnings. IFRS 18 does not ban them, but it says if management uses them in public communication, the company must explain them properly and reconcile them back to the nearest IFRS subtotal. That means less confusion and less room for companies to present flattering numbers without explanation. Another important area is grouping and disaggregation. IFRS 18 puts more emphasis on how items are grouped together or separated. Why does that matter? Because if too many things are dumped into one line like other expenses, users cannot really understand what happened. The standard pushes entities to present information in a way that is more useful and not overly aggregated. Here's a simple example. Imagine a company presents revenue, cost of sales, admin expenses, finance costs, and then also shows an adjusted profit that excludes restructuring costs. Under IFRS 18, the company can still present that management measure, but it must clearly explain what it means, why it is useful, and reconcile it to an IFRS-defined total. So users can see both the company's preferred measure and the official IFRS number. What should students and professionals remember most? Number 1. IFRS 18 is about better communication in financial statements. Number 2. It gives more structure to the profit or loss statement. Number 3. It introduces stronger rules for subtotals, management performance measures, and disaggregation. And number 4, it replaces the presentation role previously covered by IAS 1, but many broader requirements from IAS 1 still continue. So, if IAS 1 was the old presentation guide, IFRS 18 is the updated version designed to make financial statements clearer, more comparable, and harder to manipulate through presentation style alone.